Hello and good evening, everyone. Welcome to today's investor education webinar on Trust. Do you need one? By Ms. Kiran Telang. To begin with, I will briefly introduce today's speaker to you. Ms. Kiran Telang is a CFP and an investment advisor registered with SEBI. She is an author of Mindful Retirement and Moneywise Perspectives for Women and has a work experience spanning over 2 decades in banking and personal finance industry. Ms. Telang is also a part of several financial literacy programs and is also a guest faculty at IIM Indore. Now, to give you a brief overview of NISM, NISM is a public trust established in 2006 by SEBI, the regulator of Indian securities markets. The institute conducts a wide range of capacity building activities at various levels with the aim of improving quality standards in the securities markets. We provide various certification examinations, e learning programs, training programs, and various investor education initiatives, such as investor education webinar we are conducting today. So please check our website for more details, which is nism.ac.in. We are posting the various offering of NISM in the chat box. With this, I request Ms. Kiran Telang to start with the session.
Thank you so much for the kind introduction. Welcome to everyone in this session today. It is basically on trusts and do you really need one? Actually, we had done a session on special needs children a few weeks back, and I realized that there were many questions around trusts and people really wanted to understand more about it. So we decided that we should have a session specifically on trust. So I hope today you will be able to get some clarity on what are trusts and whether you really need one. So let's go ahead with the session. I will be making a presentation, and at the end of it, there will be a question and answers where you can clear any doubts that you have. So the agenda of today's webinar will follow the pattern. What is a trust? Let us understand actually what actually a trust means. Why and when do you need to use a trust? Trust versus will, setting up a trust in India, taxation of trust, and some examples. So let me first begin with a poll. Uh, could the team please present the first poll question? Please take a minute to answer the poll that will show up on your screens. You may please choose the answer of the question. How familiar are you with the concept of a trust? Your choices are, I know it well. Second choice is, I've heard of it, not sure what it means. And third choice is, this concept is totally new to me. Can we close the poll? Can we see the answers, please? Okay, great. So there are a few people who know what trusts are. 16% of people have voted for that. Many people have heard of trust, which is the majority. 61% have voted that they know something about the trust, but they're not very sure what it means. So I think we have a great audience where I'm happy to share my understanding of trust, and we can have some Q&A on that. And there are some people whom trust is a totally new topic. So welcome, and I'm happy that you'll be learning something new today. So let us move to first, what is a trust? So trust essentially is a confidence which is imposed by one person on another, and it is enforceable in law. For example, if I'm setting up a trust, I'm telling somebody that I'm giving, I'm trusting you to manage some assets or some properties for the benefit of somebody else. Trust is also a legal arrangement wherein the settler, that is I who is creating the trust, I am the settler, I'm transferring some assets to the trustee for the benefit of the beneficiary. So let me just go to the key terms which are there in the trust, and you will get more clarity about what actually trust is. So the key terms in a trust structure is the author or the settler of the trust is the person who reposes or declares the confidence. So if I want to create, I think, just give me a moment. If I want to create a trust, Just give me a moment. Something went wrong with my screen. Yeah. So, if I am creating a trust, I am the person who is reposing, I'm giving the confidence of confidence to somebody else. So I am the author or the settler of the trust. The person who accepts the confidence. So basically, the person who is going to act on my instructions is called the trustee. I am the settler of the trust. I'm telling somebody else to manage some property. So that person whom I'm giving this confidence to is called a trustee. The person for whose benefit the confidence is accepted is called the beneficiary of the trust. So if I am creating a trust for my child, I am the settler and my child is the beneficiary. And the person who will actually be managing the trust is the trustee. Now, the subject matter of the trust. So, what am I going to put in the trust? There is some property or some money which I'm going to put in the trust, which will be used for the benefit of my child. So, that property or that money or those assets are called the trust property. The instrument by which all this is going to happen is called the trust deed. So, a trust deed is a legal document wherein I'm going to mention that, this is how I'm creating the trust. These are the beneficiaries and these are the trustees. This is what I'm going to transfer in the trust, and how is the trust going to be managed? Who is going to get how much? How the trust is going to be run? What happens if circumstances change? So all that uh, data details are going to be mentioned in a document which is known as the trust deed. So I hope that is clear. The author is the person, author or the settler of the trust is the one who's actually making the trust and putting the money into the trust. The person who's accepting that confidence, basically the person who's going to manage it, is called the trustee. The person who is going to benefit out of this trust fund is called the beneficiary. Whatever assets you're going to put into the trust is called the trust property or the trust money. And the document by which this is going to be done is called the trust deed, right? So these are the basic concepts and the key terms in the trust. Now let's move to the next slide. Next poll. Could you please run the second poll question, please? So let me try and understand what is the main reason you think people create a trust. There are four choices. Please choose what do you think people create trust for. Yeah, could we close the poll, please, and see the answers? Great. So the maximum response is to protect family wealth. The second choice is to plan for dependence or special needs. The third one is to avoid disputes. And the fourth one is to save tax. So great. So a lot of people have this clarity that it is to protect family wealth and for dependents or special needs. So this is great. Let us go and look at what actually happens. So when I was talking about these key terms, so if I am a settler of the trust, why am I actually, when I'm managing things on my own, why would I call somebody else to manage it on my behalf? So if you think from that concept, I mean, from that point of view, I would need somebody else to manage my money or my wealth or my family wealth if either I am not there or if I am incapacitated. So if I'm not able to take care of things and, uh, do things as I intend to do for my family. And also, of course, there are people who are dependent on my decisions or my money, and that could be family, that could be, parents, dependent children, there could be siblings, or, there could be special needs children. So there have to be people who are dependent on your decisions, on your money. And there could be situations that arise where you might not yourself be there, or either you are incapacitated. So in those situations, is when you will need somebody else to step in your shoes to manage the property. So why people set up a trust is to protect and provide for family members and dependents. So that is obvious that if you are not able to manage, either because you're not there or because you're incapacitated, somebody has to provide for the family members and the dependents. Preventing disputes and reducing litigation. So if you clearly mention how your wealth is going to be managed and how things are going to be taken care, who will get how much, for how long will people get money out of your, wealth that you have created. So all that, if it is written down clearly, it prevents disputes and even inheritance is taken care of. Preserving and transferring wealth in orderly manner, that is what inheritance is, that you've already defined as to how the property has to pass. You can also use a trust to gift assets to minors with proper control and safeguards. For example, if you think that a child, if a child is still immature when they actually technically turn adult at 18, and you want to hold back some assets and give it to them when you feel they are a bit more mature, say at the age of 25 or at the age of 30. Or maybe some people put a condition that, when the child gets married, that is when the assets will transfer to them. So, all this can be managed within a trust structure. There could be elderly family members who have, need for financial care. And if something happens to the primary, person who's managing the wealth, then how do you ensure that the elderly members in the family also are taken care of? So again, those things can be managed within a trust structure. The most important thing I feel is that in case there is any incapacitation, so either there is physical disability or there is mental disability, and a person is not able to manage the wealth or monitor, how the wealth is being used. In that case, when a trust structure is already in place, everything is well defined, and there is no dependency on this one individual to manage things. So the people who are dependent, say if there are children or elders in the family who are dependent on this wealth, the things can run very smoothly. So you don't need that one person to take care of everything, and signatures and all those issues are kind of taken care of when there is a trust structure in place, because there is a trustee who will actually run everything on your behalf and in the manner that you have defined it in the trust deed. Another important thing about a trust is that it will bypass the probate structure. So, a probate essentially comes into picture when there is a will. So, for example, if a person passes away and they have created a will, the will needs to be probated. So, probate is essentially a thing where the court says that the will is genuine and it can be executed in the manner that has been written down in the will. So that probate is a longish process. In a trust structure, the probate is not required. So this trust can help you bypass the probate. Also, one very important thing about trust is that you are ring fencing the assets from external claims. Now, what could external claims be? Uh, so one important thing is that there could be people who are nowadays we are seeing that a lot of wealth is being created by younger people who are maybe running their own businesses, who are startup mentors, or who have their own startup businesses. There could be several inheritors who are there who are getting a lot of money at a very young age. So there could be claims on those monies from different people. So either it could be a litigation that comes out of you being in a certain position in a particular business or a company, and that litigation can impact your personal wealth. But if that wealth is transferred into a trust, that no longer belongs to you. So that amount which is passed on into a trust is ring fenced from the other litigations that can happen. Also, a lot of people are seeing that monies are getting lost because of issues of families breaking up. So there could be divorce cases where there could be huge alimonies which are involved. So the family wealth can get lost in such scenarios. So when it is put in a trust structure, it will not be touched. So the family wealth stays in a trust and it will not get lost because of these legal issues which might come up. So ring fencing of the assets is a very critical aspect why people also look at creating a trust. Can we run the third poll question, please? Do you think having a nomination is enough for smooth inheritance? Can we see the answers, please? Okay, it's fairly evenly divided. A lot of people, 33% think yes, nomination is enough for inheritance. 25% people think will is required. And a lot of people think that they are not yet sure about what is required. So this is a very interesting mix of things. So let me just bring about a few points here. So what happens when you nominate somebody in any asset? Say it could be a bank account, it could be an insurance policy, it could be a demat account, uh, it could be mutual funds. So there are different assets in which you nominate people. Now the nominee is only a trustee of the wealth that is there in that particular asset. So, if the nominee gets the money, that nominee might or might not be a legal heir for the investor. So, if the investor passes away and the money is paid out to the nominee, that only means that the financial institution has given out the money as per the investor's wish to the nominee. Now, this nominee, if he or she is not the legal heir, then the legal heirs can actually claim the money from the nominee. So nominee is only a trustee of the monies. Now then comes the question of a will, right? So if a will is written and the will is basically telling the uh, monies how, I mean, telling how the monies have to be given away to certain number of people. So those people could be legal heirs. I mean, they could be members of the family. There could be other people also who have been part of the, immediate circle of the family. They could be domestic helps who have been around with the family for a long time. So they also could be the beneficiaries of a will. There could be charitable institutions who can be mentioned in the will. So a lot of things can be written down in the will, and once the will is probated, the monies can be paid out as per the requirement in the will. Now, what happens? Why, when there is, I mean, when there is a nominee, I said that nominee is only a trustee, and a will always supersede the nomination. Now, then, if there is a will in place, do you still need a trust? Why do you need a trust? So there is this confusion, nomination is enough, not enough. If I make a will, is that enough? Or do I still need to look at trust? Let's try and answer those questions. So there are a few points of comparison. Now we are comparing a family trust versus a will. Now, when does a family trust become effective? That is effective from the date of creation. When the trust is created, it becomes effective from that date. Whereas a will comes into effect only after the death of the person. And of course, I will add one more point that only after the probate is done, that the will can come into action. Now, control over the property. Now, if you're moving the assets into a trust, it will allow you distribution and management during lifetime and after death. So both way, I mean, the money can be moved into the trust while you are living. So that is called a living trust, or you could write a will and make a trust in the will. That is called a testamentary trust. We'll come to it a little later. So you lose the control over property when you are moving the assets into a trust. Whereas a will, since it is coming into effect only after death, so it will only operate after the death of the person who written the will. Now, property covered under a family trust, it will be only those assets that you move into the trust, not everything. So if you own several properties, say you own land, you own houses, you own shops, you own mutual funds, you own stocks, postal deposits, you own a PPF account. So you can choose what you're putting into a trust. So the property will be shifted to the trust, which you can choose. A will can cover all assets that are owned at death of that person, unless something specifically excluded. So you can write in a will that these XYZ assets need not be considered when I'm, giving it to the beneficiaries. Now comes the court involvement. This is what I was mentioning earlier, that when there is a will written, for the will to be executed, especially when there is, real estate involved, when there is property involved, a will usually requires a probate. So probate is mandatory in certain geographies of India, while it is not mandatory in majority of India. But in practice, what happens is that unless there is a probated will, the assets are not transferred into the name of the beneficiaries mentioned in the will. So in effect, practically, you need to probate a will. So that probate thing comes into picture when there is a will. In case of a family trust, probate is not required. And there is minimal court involvement. I mean, there is actually no requirement of going to the court when you're setting up a family trust and when the person who has created the trust is no more. Privacy is another concern. So a will becomes a public document once it is probated. So anybody can access the will and figure out who's getting what were the assets involved. So it becomes a public property. Whereas a family trust remains very private because there is no probate involved. It does not get into the into the public domain. There is a lot of flexibility in terms of a family trust, it can be amended or revoked. Now, depending on how the trust is created, we will come to the types of trusts. So, depending on that, there is a lot of flexibility in certain trusts that you can create. The will can only be changed during the lifetime of the person who's writing the will. And it is final after the death. Obviously, there cannot be any changes made once the will, once the person has passed away. In a family trust, the trustees can manage the assets without interruption, whether the person who's, the settler is alive, not alive, or incapacitated. In all situations, the trustees can manage the trust without interruption. The flows of money to the beneficiaries will continue as per whatever has been defined in the trust. Whereas in case of a will, there is an executor who's mentioned in the will. So the executor can execute the will only after it is probated. So whatever has been mentioned in the will that XYZ property goes to my son or XYZ property goes to my daughter, all that can be executed only after the will is probated. The cost and the maintenance in will is very low. So you can write a simple will and you can just register the will. There is no cost for registration. The probate may add some cost because there is a court fee that needs to be paid and there will be lawyers involved. So there is a cost associated to that. So initially, in case of will, the charges are very, very low, but the probate will add up charges. In case of a family trust creation, the initial setup can be a little expensive because there will be legal representation that will be required, and there will be also an ongoing administration cost of maintaining the trust. So these are essential points which are differences between family trust and will. So if I would like to put it simply, that all assets that you own need to have a nominee because that will give the ease of passage of monies from the financial institutions to the nominee. Once the nominee gets the money, nominee, if they are the legal heirs, then the matter is over. But if they are not legal heirs, there are other claimants, then the will comes into the picture. So essentially, if things are simple, make a will and define whom you want to, pass on your assets to in what proportion or what specific assets need to go to somebody within your family or outside your family. If things are more complex, then you look at family trust structure creation. Now let us move to the next sheet. How do you actually set up a trust in India? So there are certain steps. You have to first draft the trust deed. You have to register the trust. You have to get a PAN card, open a bank account, and transfer assets. So these are essential things. Now, when you are actually, thinking of setting up a trust, there are three key professionals whom you need to involve. One is a financial planner, another is a chartered accountant, and third is a lawyer. Now, each of these professionals have different roles to play in creation of a trust. A financial planner is a person who can, who has an overall overview of your family wealth, legacy, what you're thinking, what are your requirements in the family, how do you intend to, transfer monies, or what could be the issues involved if, things are not in order. So the overview is available with a financial planner. They can help and guide you as to whether you need a trust or you don't need a trust. What could be the options that are available, and also what assets you need to move into the trust, how the cash flows will continue. All those things will be on overview available with a financial planner. The second most important, once you've decided that a trust needs to be made, then a lawyer involvement becomes important because trust is a legal document and it can be a very, very complex document depending on your particular position. So, depending on whether all the beneficiaries are in the country or there are multiple geographies involved, the assets could be located in different states. There could be different types of assets. The dependencies could be different. There could be, maybe a special needs child in the family. There could be other children in the family. So how do you, draft the deed in a proper manner? That is very, very crucial. So you need a lawyer to be involved in that process. A chartered accountant will take care of the taxation. So obviously anything related to the assets moving into the trust, how will it impact? I mean, what will be the taxation? When the income is generated, what will be the taxation then? Managing the paperwork, filing the returns, all that is a part of the chartered account. So creating a trust, I think these three key professionals need to be involved. And of course, there is this registration of the trust, which will happen at the sub-registrar's office. A PAN card application is like you apply for, a normal PAN card. The trust PAN card is separate because it's a separate entity. And you will need a PAN card to open a bank account because all the, money of the trust, the income, the assets, everything will move through the bank account. And once everything is ready, then you can actually move your assets into the trust. These are essential types of trust. So public trust, private, revocable, irrevocable, and testamentary. So today's session is essentially about private trusts. So public trusts are those which are for benefit of general public. So there could be schools or hospitals which are run under trust structures. There are a lot of religious institutions also which are under trust structures. So those are public trusts. In private trust, it is essentially for specific individuals or family members that you're creating a trust. The differentiation here in the revocable and irrevocable is that once you set up a trust, what if you change your mind later? What if you don't want the trust anymore? Or what if you want to change the terms and conditions of the trust? So, in that scenario, if you feel that you're still unsure, a revocable trust would be an answer because it can be modified or cancelled by the settlor at any point in time. An irrevocable trust, once created, cannot be altered. So, the name itself says that it cannot be altered at any point in time. A testamentary trust is an option where you can write a will, and within a will you can say that these assets will move into a trust. So that is a testamentary trust. It will come into existence once a will is probated, and the trust can be created and assets will be moved into the trust after the demise of the settlor. So basically, the person who's writing a will also be the settlor of the trust. So that is a testamentary trust. Now, this becomes important. The taxation of trusts will differ depending on what kind of trust you are making. So, revocable trust, the income will be taxed in the settler's hand. Now, if you think of the logic behind this, that the settlor can any point of time close the trust. So, essentially, he has the full control of the assets. So, the assets are still belonging to him. So, in that case, the authorities say that the uh, assets are still the settler's ownership. So in that case, the settlor will be taxed for the income of that particular trust. Now, irrevocable trust, again, there are two types. It could be a determinate trust or it could be a discretionary trust. Now, a determinate trust is where, the beneficiary, basically you say that the beneficiary will have certain percentage. Say there are three beneficiaries, A, B, and C. So A gets 35%, B gets 35%, and C gets the remaining. So 30% will go to C. So the percentages or the proportions in which the benefits will be given are predefined. So that is a determinate trust. A discretionary trust is where the beneficiaries are defined, that A, B, and C are the beneficiaries, but the percentages are not defined. So what is the actual division of the income or the benefits of the trust are not given. That is entirely dependent on the trustees. The trustee can decide that in some year that the 50% will go to A and 50% will go to B, and C will not get anything in a particular year. So the entire power is in the hands of the trustee. So that is a discretionary trust. So when the trust is irrevocable and determinate, then the income will be taxed in the hands of beneficiaries. When the trust is irrevocable and discretionary, so where the trustee has the full power, then in that scenario, the maximum marginal rate of taxation will be applied to the trust income in the hands of the trust. So why these two types of trust, and how do you actually, differentiate between what you should do if you have decided that, okay, I want an irrevocable trust, then how do you differentiate? So you have to look at a kind of thing where do you need flexibility. So in a discretionary trust, what happens is it kind of takes care of, changing circumstances. So in some year, maybe amongst the 3 or 4 beneficiaries that you have defined, say if you talk about ABC, that example that we were talking earlier, in certain years, maybe A is going through a difficult phase. Maybe there is some illness or something where A needs more money. So the trustee can decide that, okay, in this particular year, A needs more money, so we will give more money to A. Suppose there is some problem in some year where B is facing some legal hurdles, and if that income comes to his or her hands, that income might get lost. So in that year, probably the trustee can decide that, okay, I will not give anything to B in this particular year. In certain years, C might have a higher requirement. Maybe he or she is going for higher studies, and that demands a lot of money for those particular 2, 3 years that he or she is going to be, pursuing higher studies. So in those particular years, C will get a higher proportion. So the entire thing can be adapted as per the needs. But again, there is a lot of power in the hands of the trustee. So the trustee has to be honest and fair and do the right things as per the beneficiaries' needs and requirements. In determinate trust, it's simpler. You know that XYZ will have this kind of benefit and this will continue for a period of time. So depending on what your requirements are and what you're more comfortable with, you can choose between determinate and discretionary trust. Now, testamentary trust, as I said, they will be created by a will and it will take effect after the death. Now, when you're creating a testamentary trust, there should be 4 things that have to be taken care of. That the intention should be very clear. It should be clearly written in the will that, this is my intention to create a trust after my death. The purpose, that is the stated use of the trust property. So why is this trust being created? That has to be very clear. The beneficiaries have to be named very clearly. It has to be very clearly identifiable that this is the beneficiary. And the properties also must be very clear that these properties will be moving into the trust. So these 4 conditions have to be satisfied. So since it is going to be a testamentary trust, there is no registration involved because that will come into existence only after the will is probated and after the person is no more. And trustees can be separate from will executor. So you need not have the same people as the executor of the will and the trustee. A testamentary trust actually allows allows to retain control over assets during the testator's lifetime. So if I'm making a trust during my lifetime and saying that after my death, the monies will go into a trust. So during my lifetime, the entire control of those assets is still with me. And of course, the flexibility of amending the will through a codicil or making a new will is always available. Trust comes into effect after death and after probate. So these are important conditions. The executor will implement the will and the trustee will administer the trust. So these are different roles. And there is also an option to appoint professionals as trustees, and you can also define the fees for professional trustees within the will. So this is about testamentary trust. This is just a brief, comparison of lifetime trust versus testamentary trust. We have already discussed this. I'll just run through this in a bit. Created during the settler's lifetime is a lifetime trust, and testamentary trust is basically created after the death via a will. Control of assets is lost upon transfer if it is a lifetime asset. So as soon as you transfer the asset into the trust, you lose control over the asset. The testamentary trust, the asset control is retained till death. Is it revocable? Yes, you can define a revocable trust or irrevocable trust when you are creating it. A testamentary trust is freely revocable until death of the testator. Registration is needed in case of a trust, yes, and stamp duty might be applicable. In case of a testamentary trust, since it is being written into a will, there is no stamp duty or registration required at that point in time. Privacy, of course, lifetime trust is more private, whereas a testamentary trust, because the will can be a public document after the probate is granted, the testamentary trust might again become a public document. Legal framework is lifetime trusts will fall under the Trusts Act, whereas a testamentary trust will have 2 things in picture. It will be Trusts Act plus Succession Act. Regulatory benefits may vary in the lifetime trust, and in a testamentary trust, because it is passing on as inheritance, there might be a lot of exemptions which can come into play. So that will depend on what kind of asset is being passed on through the testamentary trust. So as you see, there are differences, and you will definitely need help in terms of legal help and help of financial planner as to what is going to be put into whether you need a lifetime trust or you need a testamentary trust, what goes into a trust, what is outside of trust. So all these things will have to be discussed. So let us also look at the other side, disadvantages of a trust. So since we, ran that poll at the beginning, a lot of people didn't know about trust or were not very clear. So we ran through some points. Now, as you see, the structure may be complex in case of a trust. It could be expensive to establish and to maintain as well. There could be transfer, a higher cost of transfer. So if you're moving real estate into a trust, there is a stamp duty applicable, and stamp duty differs by the state. So that can make it very expensive. Also, when you, come to sell the property, so if it's especially real estate within a trust structure, it practically is a little more difficult to sell when it is in the trust, because there are a lot of complication associated with the trust, where if the beneficiaries are minors, then their whether that is accepted, a lot of complications come into those structures. So typically, people avoid moving real estate into trust structure. So if a trust structure at all defined, real estate is generally tried to be kept out of it. There is no control of the settler over the properties that are transferred to the trust. So the control is lost. The powers of the trustees are restricted by the trust deed, but as we saw in case of a discretionary trust, the trustee could have a lot of power. So you need to have really, good trustees. So a lot of times, while your intention is good, you might not find people who you can, believe to be good trustees and who will act in confidence on whatever you want to do. Let us take one example. uh, a will versus case, trust of Mr. Rajan. His age is 68. Mr. Rajan owns these kind of assets. He has a house, he has mutual fund investments, he also has a business, and he has some bank accounts. He has one dependent child who's a child with special needs, and he has two other adult children. Now let us run our last poll number 5, please. Fantastic. So 73% people have chosen a combination of a will and a trust. So I'm happy that some points are getting through. So this shows that what I've mentioned so far looks interesting. So let us see what happens. Right. So in case of a will, Mr. Rajan, if he writes a will and gives equal shares to all children, he names the elder son as executor. The will come into effect on death and may go through probate. So that is the way things will happen. Now, the problem with using a will could be, when there is a special needs child, will that child's requirement be taken care of after the parent is no more? So that is a question mark. So while the assets can be transferred to the special needs child, how will it be managed? So that could be a problem, right? So, and of course, because there is a probate involved, there will be charges which will have to be paid. The court fees will need to be paid. Now, if you use a trust, if Mr. Rajan decides to create a trust, he sets up a private trust during his lifetime. He transfers mutual funds and part of business into the trust. He names a corporate trustee to manage assets for the special needs child. So the gap that we saw when he was only doing a will, that is being taken care of by nominating a corporate trustee to manage the assets for his special needs child. So even if he's not there and his two other children are not willing to take the responsibility of providing and managing things for the special needs child, a corporate trustee will ensure that as per the trust deed, the special needs child is taken care of for a lifetime. So that becomes a very critical aspect of the creation of trust for the child. Now, when we look at a combined approach, a trust, as we saw in the last example, that the trust will handle the lifetime support and complex needs for the special needs child. And the will can distribute his other personal assets that are not part of the trust. So the other children will also be taken care of very well. And he's ensuring that after his passing, also the adult children are not burdened by, the requirements for managing the special needs child's lifelong requirement, which will probably run, if he's a younger child, will probably run into a very, very long period of time. So a combined approach can work better in a lot of cases. Now that will essentially have to depend on what the family structure is, what are the requirements, what are the assets that are involved. So that is how a combined approach can be depended on. So, as a summary, trusts can be very useful tool in estate planning, and always use professional help to create a trust, because, as I said, creating a correctly drafted trust deed is very essential to run things the way you intend to run them. Ensuring proper drafting is critical, and ensuring good choice of trustees is even more critical. Because if you do everything perfectly and if the trustees are not trustworthy, all that you've done so far might not really help. Drafting and choice of trustees is very, very critical thing. So that's it. Thank you from my side, and we'll be open for question and answers. I'll stop sharing the screen so I can look at the question and answers.
Now I request participants to ask questions in Q&A section so that ma'am can address the question. There are already few questions, ma'am, in Q&A section.
Yeah, is the trust formed or created for AMC also on the same pattern? So yeah, trust all fall under the Indian Trust Act. So the structure is same, but it is the beneficiaries are different, and it is not a private trust. So Mr. Firoz Ahmad, currently investing. Mr. Ahmad, it is a very specific query. I don't think I can answer this query here. You've given very specific requirements for your family. I would request you to, engage a professional to get answers to this. Mr. Vivek Yadav is asking how to deal with real estate when you have multiple, you have it in multiple locations and expect the price to rise in near future, but the kid is a minor. Uh, Mr. Yadav, I think there are two questions that you are asking here. One is that your expectation of price rise. So that is an investment question. So let us keep that aside for the moment. If you have real estate and you intend to pass it to a minor child, there could be two ways. One is, you can write a will in which you can mention that these real estate properties, after you will pass on to your child. And since the child is a minor, you will need to put a guardian for the child till the child becomes major. So the identification of a guardian who will manage these properties for the child becomes essential when you're writing a will. Now, if you decide to create a trust, as I said, putting real estate properties into a trust creates a lot of complications at the time of selling. So probably if you are planning to invest in real estate and sell it in a short period of time, maybe trust would not be your answer. But yes, writing it in the will definitely makes sense, because then you're ensured that the property passes on to your child, even if the child is a minor. Okay. Manish Gupta is asking cost of transferring assets to the trust. Uh, so you can move, different assets will have different costs. So like I said, real estate is the most expensive thing to move into a trust, because there will be stamp duty if you are, putting the real estate into trust. All other things can simply be gifted into a trust. So you can gift mutual funds, you can actually open a bank account and put money into that account, and obviously there's no cost for that. So that is how you move things into the trust. Ashutosh Pandey is asking how to utilize trust to reduce capital gains from stock markets. Ashutosh, the idea behind a trust is not to reduce your capital gains from stock markets. As we discussed, the idea is totally different. Uh, so, because assets are being moved into a trust, and if there are capital gains in that, the taxation will anyways have to be paid either by the trust or by the beneficiary or by the settler, depending on how the trust has been created. Like we discussed, revocable, irrevocable, discretionary, determinate. So, basis the structure of the trust, the capital gains will devolve on whoever is the deemed owner, as in either the trust will pay the tax, or the settler will pay the tax, or the beneficiary will pay the tax. So you really cannot, avoid taxation. So the primary thing is not to avoid taxation. The requirement, the need for creation of a trust is totally different. I mean, it is not, a tax tool basically. Abhijit Satpute is asking why the trust is not that much popular than a will. So, Abhijit, as I said, the trust is a very good tool, but there could be complexities involved. It is a little expensive to set up a trust. And also, you have to decide what is the point where you think a trust will make financial sense for you, because there are costs associated with it. You will have to maintain the trust over a long period of time. So, whether the assets that you have created really demand having a trust in place. So there could be different answers for different people. So somebody with a 1 crore asset size also might think that this is my hard-earned money and I will need to put it in a trust structure so that I'm ring fencing my assets. Somebody with say 10 crores might think that no, I'm okay. Let me keep things simpler and let me put nominations and will into place. So each person will have a different answer. There's no hard and fast rule as to uh, you have to create a trust at a certain stage in life. It is how you foresee your family situation, how you foresee the risks in your situation, whether your dependents will be able to manage or not manage. There are a lot of things to answer before you decide to create a trust. Whereas in case of a will, it is pretty simple. If you have any assets, writing a will is a very, very simple thing. If there is no cost involved in it. Registration will have some minimal cost. If you go through intermediaries, there'll be some minimal costs which are involved. So will becomes a much simpler tool for succession. So that is why will is more popular. But I would still say that not many people still write wills also. So we are still at that stage where we are teaching people to make nominations in all assets, and then we come to the will, and now we are talking about trust because the wealth is increasing in the country. So I'm seeing that trust has become a topic of a lot of interest, and over a period of time, I'm sure they will also become pretty popular in India. Viral Trivedi, is creating a trust equal to estate planning, or is it broader? Viral, I would say that trust is a tool for estate planning. So depending on the requirements of the family, as we discussed, like in that example also that we had taken, uh, the trust can be one tool in addition to other tools which are available. So nominations, wills, and trusts are a combination which can be used for estate planning. So depending on your requirements, depending on your dependencies, you can choose a mix and match of these estate planning tools. Shreyansh Shah is asking, trust created without any real estate should be registered with the sub-registrar. This sub-registrar of trust register or real estate register. So, Shreyansh, any trust that you're creating, it is better to register it whether or not it has a uh, real estate inside the trust. So when actually you are registering the trust, there might be some minimal amount. Usually you just put some maybe 10,000 or 50,000 into the trust and register the trust, because everywhere when you go for opening bank accounts or other things, a registered trust is a requirement. So whether or not real estate is there, registration of trust is essential. Sub-registrar's office, the same as where you go for registration of other documents. That is the office where you will need to go for registration of your trust as well. So as I said, a legal involvement is necessary. So a lawyer will be able to guide you better on these points. Kilari is asking, interstate inheritance and probate are mandated in trust. Are there any witness signatures required? If so, how many witnesses? Kilari, I'm a little unclear about your question here. So, a trust is a registered document. So, obviously, when you go to register a trust, witnesses will be required. Typically, there are two witnesses who are required. And I don't know, I mean, interstate inheritance, I really didn't understand. So, witnesses are generally required in most legal documents that you're registering. Rajput Hari Singh is asking, what is trust setup cost and what is the running cost of trust? The trust setup cost can differ. There will be a legal cost involved, as in the lawyer's fees will be involved. So it could range anywhere between 50,000 to, it can run into lakhs as well. So depending on the complexity of the structure that is required, the trust structure, the cost will be different for setup. Again, the management cost also depends on what is the complexity. So it could, I mean, if you are involving a corporate trustee, there'll be a regular fees which will have to be paid. If you're running the trust yourself, then obviously there's no professional fees that will be involved, but there will be taxation costs, there'll be filing costs, So there's the running of the cost, running the trust, if it is a simple trust and you're doing it yourself, might be very low. But if there is a complex structure, there might be a significant running cost as well. Anonymous attendee, can business also be transferred through this? Yes, it is possible to transfer business also into a trust. Manish Gupta. Cost of transferring assets to trust. Is the stamp duty registration same for immovable assets? So yes, there is a stamp duty involved when you are moving real estate into immovable assets into the trust. There will be a stamp duty and it will differ by state. So every state has a different stamp duty for immovable properties to be moved into a trust. Manish Gupta is asking no gift tax. So see, gift taxation comes into picture depending on who are the beneficiaries in the trust. So if the beneficiaries are family, so there is a section 56 of Income Tax Act which defines relatives. So there is a list of people who are considered relatives, and any money transferred to them as gift is not considered for taxation. So if your beneficiaries in your trust are your relatives as per that definition of section 52, then there will be no gift tax on the uh, uh, properties that are being transferred. But if there are people who are not relatives, then it becomes a different thing and then it becomes taxable. So if there is also a combination of relatives and non-relatives, there are some case laws which show that it becomes a taxable transfer. Dr. Srihari Kumar is asking, can a trust be involved in trading? Uh, See, actually, what a trust can do and cannot do is written in the trust deed. So it has to be, that is why the drafting becomes very important. So what is allowed, what is prohibited, or if you want a broader definition of what can be done and what cannot be done, you have to mention it into the trust deed, and the trustee will have to follow what is written in the trust deed and accordingly manage the trust monies. Nikhil Purohit, transfer of trust in minor child in property assets to be legally work in eyes of government. Nikhil, if you could just reword your question, please. I did not understand this question. Simran is asking, can business also be transferred through this? Yes, business can also be a part of the trust. Raju Keshwar is asking, explain the procedure for probating a trust. Raju, trust does not need to be probated. A will is probated. Manish is asking, in discretionary trust, once it is taxed at trust level, will it be still taxed at beneficiary level? Manish, I think yes. I'm not very sure on this. I will need a CA to clarify on this one, but I think it will be taxed at beneficiary level because uh, the definition itself says that maximum marginal rate in a discretionary trust is applied because the beneficiary's part is not really clear. So when the beneficiary gets the money, that becomes his or her income. So logically speaking, that should also be taxed. The beneficiary will be taxed on that income received from the trust. But yes, a CA will be able to give a better clarity on this. Pradeep Belwal is asking, can trust deal in sale purchase of stocks from mutual fund? If yes, what will be the tax liabilities? Pradeep, as I said, what a trust can do and not do has to be defined in the trust deed. If it is defined that they can deal in sale or purchase of stocks or mutual funds, then it can be done. And trust will have, tax liabilities as per any other investor. I think we have covered most of the questions.
Yes, ma'am. I think you have answered all of the questions actually asked.
So I think there are no more questions. I think we have finished the list of questions that were asked.
Yes, ma'am.
Thank you so much, everyone, for your interest. And
Yeah.
it was a good Q&A. I really loved answering these questions. Thank you so much.
Yeah, thank you so much, ma'am. I would like to extend a heartfelt thanks as well for taking time and speaking at our webinar. Your insights, expertise, and presentation as well, ma'am, truly made a lasting impact on our audience. Thank you so much again, ma'am, for sharing your time and knowledge with us. Thank you.
Thank you.
Wishing you a wonderful day, ma'am. Thank you.
Thank you.
And also thank you to participants as well for joining us today. Your presence and engagement truly made the session meaningful and impactful. Yeah. Thank you all for joining us today. Thank you.